Welcome to This Explainer. Today, we're unpacking the hidden mechanics of modern debt, diving into a really fascinating analysis from Money Made Simple. We're going to look at the financial system, not how it's drawn up in some dry textbook, but how a bank actually operates it in the real world. Seriously, by the end of this, you are going to see your monthly statements in a completely different light.
Now, if you're like most of us, you probably spend a massive chunk of your life just in constant motion. You know the drill. You're working, you're earning, you're paying the bills, but somehow you just can't seem to stop. It literally feels like an exhausting treadmill. And just when you think you're finally making progress, why does the finish line of a completely debt-free life keep moving further and further away? It's honestly like the track was specifically engineered to keep you running right in place.
Section 1. The debt-free illusion, the exhausting loop of modern life. So, to understand exactly how this treadmill operates, let's map out the standard milestones of modern life. I'm willing to bet this is going to look incredibly familiar. Year 1, you take out student loans for the degree. Year 5, you sign a car note just to commute to the job you got with that degree. By year 10, boom, you take on a massive mortgage for a home. And hitting year 15, well, you're probably relying on credit cards to fund everything else in between. We're all taught to view these balances as just temporary hurdles, right? Like temporary things to clear before our real lives can actually begin. But the reality presented in the source analysis is honestly pretty stark. Most people spend literal decades caught in this exact loop, often feeling this deep sense of personal failure when that debt-free milestone stays, well, forever out of reach.
Section 2. Debt is a consumer product. Engineering profit.
Well, that feeling of failure? That is totally by design. Because to a bank, your outstanding balance is absolutely not a mistake they want you to fix quickly. Not at all. It is literally their core product. I want you to think of interest as a recurring subscription fee that you pay just for the privilege of using their cash. Just like you pay a monthly fee to stream movies or listen to music, when you borrow money, you are essentially subscribing to that cash. Let's ground this in a really concrete example to show you what I mean. Let's say you're holding a $5,000 credit card balance at a 20% interest rate. Sounds pretty manageable, right? Kind of just a routine expense for a lot of households. But let's look at what actually happens to that specific product over time.
Just look at the massive gap here. On one hand, you've got the original $5,000 you spent. On the other hand, you have the absolute astronomical total cost of keeping that balance open by only paying the minimum. The gap between what you bought and what you eventually pay widens so dramatically. It multiplies the cost of your original purchase several times over, completely draining your wealth in the process.
And how do they make absolutely sure you stay stuck in that widening gap? Simple. The minimum payment. As the analysis points out, the minimum payment acts purely as a user retention strategy. It is perfectly engineered to keep your account active and keep your subscription rolling, all while barely making a dent in the actual principal loan amount. This allows the interest curve to just aggressively grow, stretching what should be a simple repayment out over decades. And if you stumble, late fees and penalties kick right in to push their profit margins even higher. It ensures this product stays incredibly lucrative for them, even when you, the borrower, are struggling. The entire business model is basically designed to maximize the lifespan of your debt.
Section 3. The global debt engine, fueling the macroeconomy.
Now, this whole product strategy, it isn't just some clever retail banking trick. It is the literal engine driving the global economy from the top down. Step 1, central banks lower interest rates. Step 2, this makes the debt product we've been talking about much cheaper to buy. Step 3, because it's cheap, household and business borrowing scales up aggressively. Basically, the bank's total customer base expands. And finally, step 4, this continuous massive borrowing fuels the consumer spending that drives corporate growth and pushes the stock markets ever higher. Our entire economy thrives on the mass consumption of this debt product.
And here is where the mechanics get truly mind-bending. Modern banking actually works through a process where issuing a loan literally creates new money into existence. Yeah, you heard that right. This means if every single person in business woke up tomorrow and just paid off all their debt, a massive portion of the global money supply would completely disappear. The entire economic framework as we know it would drastically shrink.
So the really crucial point here is captured perfectly in this quote. The global financial system structurally requires a constant supply of new debt just to remain functional. The system doesn't just want you to buy its debt product, it fundamentally requires you to, because without it, the whole machine grinds to an absolute halt.
Section 4. The invisible behavioral cage, modifying human behavior.
But the impact of all this goes way beyond just the financial mechanics. When you're tethered to a strict, non-stop schedule of monthly obligations, your behavior actually completely changes. Suddenly, you become intensely risk-averse. I mean, people will stay in jobs they actively dislike because they simply can't afford to miss a payment. Starting a business, taking some time off, taking any kind of financial risk, it's just actively avoided. A steady, predictable income gets prioritized above passion, innovation, and honestly, sometimes even happiness.
Ultimately, what this ends up creating is a highly compliant workforce. A heavy, lingering obligation basically acts like a self-imposed cage that dictates how a person lives their daily life. You aren't just paying a bank, you are paying with your freedom of choice, neatly tying yourself to the broader economic machine. Section 5. Building Fortunes versus Cages, the ultimate cheat code.
Now, the system aggressively markets this debt product to you, but you'll notice it rarely gives you the instructions on how to stop being used by it. But there is an ultimate cheat code here, and it's hidden right in plain sight. Most everyday consumers use debt to purchase depreciating liabilities, things like cars or consumer goods, that constantly drain their wealth every single month. But wealthy institutions and individuals, they use the exact same tool, debt, to acquire cash-flowing assets. They buy investments that generate more money than the cost of the interest itself. One group is using the product to build a cage of obligation, and the other is using the exact same product to build a fortune.
Breaking free really starts with a major shift in perspective. As the analysis concludes, understanding that your monthly payment is the bank's most valuable asset is the first step toward changing how you engage with the system. Once you recognize this underlying business model, once it clicks that your debt is their product and your minimum payment is just their retention strategy, you can finally begin to step off that exhausting treadmill.
So I want to leave you with this final, provocative thought to chew on. As you look at your own monthly statements, your own obligations, and your own financial journey, ask yourself, are you using this financial product to build a cage, or are you using it to build a fortune? Thank you so much for joining me for this explainer. Keep questioning the systems around you and use this knowledge to take back control of your financial future.